Hello, investors and traders. In today's video, our focus shifts to three individual securities from the Magnificent Seven, set to announce their earnings today: Apple, Amazon, and Meta. Recapping recent market movements, U.S. stocks experienced a downturn on Wednesday, with the Nasdaq leading the decline by over 1% at the open. The lackluster performance of tech giants' earning results contributed to this negative sentiment. The S&P 500 also traded lower, down approximately 0.5% after reaching a record high on Tuesday. Meanwhile, the Dow Jones Industry hovered around the flat line at the open. By the end of the day, all three major indices were down at filming: S&P minus 1.51%, Dow 0.77%, and the Nasdaq down 2.08%. We accurately predicted this down day in yesterday's video using the Ridex ratio. Additionally, a spoiler alert for the year: is anticipated to be a selective bullish year where specific stocks will play a pivotal role in keeping the overall market positive. The Magnificent Seven names, including Microsoft, Alphabet, and chipmaker AMD, were in the spotlight during Tuesday's earning releases. However, all three stocks faced declines on Wednesday, with Google, Parent, and AMD experiencing over 5% drops, surpassing Microsoft's modest decline. This underwhelming start from these tech megacaps, crucial for the S&P 500 this earnings season, may bring unease to Wall Street. The focus now shifts to the upcoming reports from Apple, Amazon, and Meta on Thursday. In parallel, the Federal Reserve announced its decision to maintain the benchmark interest rate in the range of 5.2% to 5.50%, the highest since 2001. The Fed expressed caution, stating it won't consider lowering interest rates until there is a more confidence in inflation returning to the 2% target. The committee does not expect it will appropriate to reduce the target range until it has gained a greater confidence that inflation is moving substantially towards 2%. The Fed stated its policy statement. Before we go over the three individual securities, I want to go over two scenarios. The first is the presidential election cycle. The presidential election cycle says that the fourth year going into the election year is usually an up year at 7.5%. And one of the reasons why is any president who is inside the office wants to keep the market positive to show that he has done a good job in the economy. Usually the third year is the best year, and the year after, 2 years following, will be poor years. Now, this year we feel that it will be a very selective year, and the three stocks we'll be recommending today to buy on pullbacks are three stocks will give this year a bullish ending. Last year, we told you about a remarkable track record. Once the S&P is off 20% off the bare lows, a year later, stocks have never been lower. And this is what triggered us to keep telling you all of last year to buy on the dips, to buy on the dips. We feel this year, nothing has changed except there will be less stocks that we can buy on the dips. But I want to show you the formula that worked last year. The market was in a bear market. Then we had capitulation. And each time the market dipped, we told you to buy more. And every time the market went higher, we had more and more confidence. So this formula of buying on the dips this year will also work well, but more selective. And the market is down today, but is not capitulation. And we might sell off for a week or 4 weeks, but the overall trend is still bullish. We are not always bullish. Some years, like in the year 2022, we were shorting into the market. And every time it rallied, we short into the market. But like last year, the idea is to buy on the dips. Before we get started, disclaimer: the information provided on our channel is for educational, informational purposes only and is not intended to be a substitute for professional financial advice. Do your own homework. Talk to your financial advisor. The important part is finding your indicators that work for you. The important part is building your system that works for you. You can be a fundamental, you can be a technical, You can be analytical, you can be historical, but a system that works for you. As you know, we have a three-part process. We look at the overall market, we look at the sector phase, and then we go to the individual securities. This video is all about individual securities and 3 securities we've had for the last year and 1 month. Even though it's not an official sector, it is what we call the Magnificent Seven, which we have been proponents for the last 1 year and 1 month. Amazon will be releasing earnings today. We have held on to Amazon since January 1st, 18 of this year with a 59% gain. I want you to go remember back to the capitulation that we talked about, and every time Amazon fell, it was buy on the dips. Even when it came down and it came close to its 200-day moving average, the same scenario happened. Every time we bought on the dips. Recently, we've been telling you, wait. In fact, even yesterday, we gave you one of the indicators, the RIDEX ratio, which warned us that this market was going to sell off today. We have Amazon in our long-term position. We are not holding any in our intermediate term or short-term position, hoping for a sell-off. Even if the earnings are good today, we have our long-term position open. And if earnings are not good today and we get a pullback, this could be even better for us because we feel Magnificent Seven will be higher than even what it is today. What are we looking for? We are first looking for the growth phase. We are looking for a stock that is moving upwards. Clearly, even with today's down day, Amazon is clearly on an uptrend. The overall market has not had capitulation, and neither has Amazon. Let's go into our investment philosophy when buying. Are we in a bull market? Yes. 1 day does not pull us out of the bull market, neither does 4 weeks. After such a huge run-up, having a pullback is only buying opportunities. And we showed that to you at the beginning of this video. And just now, every time Amazon pulled back, it was a buying opportunity. Yesterday, we warned you about Amazon, QQQs, Google, Microsoft being overbought. So we will wait for our oversold indicators to get in. Is Amazon cheap? No, Amazon is not cheap. And that's the way we like it. Clearly, Amazon is on an uptrend. Do we have stop losses in play? Yes. Have we maintained consistency on our approach? Absolutely. We are looking for stocks trading above the moving averages, looking for stocks hitting new highs, then pulling back and then getting into it. We are looking at the overall market and anticipating if the overall market falls, so will Amazon pull back. And if Amazon does announce poor earnings, it is only a buying opportunities for the weeks coming ahead. We have done this same idea after earnings of the Magnificent Seven, going in a lot of times last year, buying into it. Today, we are not buying into Amazon, but we are holding our long-term position. And we're actually hoping for a healthy pullback on Amazon to get in. Out of the Magnificent Seven, Tesla is only one looking very poor. But out of the 7 Magnificent Seven, 6 of them are looking very favorable, thus saying that our short-term indicator is at neutral. Also, for our medium, long-term, and as a swing signal, it is also neutral. As we told you, it's worked very well last year. We are looking to buy in overbought, oversold components when this number is at 25. After today's sell-off and maybe tomorrow's sell-off, this number will be much lower and possibly an opportune time for us to start to looking at some of the securities, which we will be telling you on this video. We also want you to pay attention to the CCI Commodity Index on each one of these 3 securities. And on the pullbacks, when it hits the bottom over here, minus 100 or minus 200, and then turning upwards, it has worked, and we will be using the CCI indicator to time the market for these securities, for the intermediate term, and also for the short term. From being such a good position for such long, the RMO, Rahul Mahinda Oscillator, all 3 signals are a buy. So for Amazon, we have a long-term position in our overall portfolio. We are expecting a short-term and intermediate-term sell-off for Amazon. When this happens, the same thing we did each time Amazon sold off, we will be doing it again. We're expecting a 135 to 145 pullback. If we are wrong on Amazon, we still are contributing to our gains on our long-term positions, which we've held for over a year. The next security, Apple. Many years ago, they said how GM, General Motors, went, the rest of the market goes. Thus saying that the new rule is how Apple goes, the rest of the market goes too. And like a broken record, capitulation happened. Apple went lower. It was in a bear market. Then it went skyrocketed, and it had very little chances to buy on the dips. But recently, in Q3 2023, you had a chance to get in. And each time on the dips, you were rewarded. Even most recently, when it touched the 200-day moving average, it still went upwards. We expect no matter what happens today, even with poor earnings, if you believe this year, because of the presidential election, will be an up year, Apple will be clearly leading the way. So if Apple comes out with poor earnings, we may not be buying tomorrow, but when our oversold indicators become even lower and our components to the oversold indicators become lower, we will be buying more Apple for our intermediate term and short term positions. Go over our investment philosophy when buying. Are we in a bull market? Yes. Are the oversold indicators at high probability chances? Well, they could get better. Is Amazon cheap? No way. Do you think Amazon is on an uptrend? Clearly, if you look back at Q4 2022, we are clearly seeing an uptrend. That's why we have a 37% gain on Apple. And we go further. We would love to see the CCI indicator fall to the minus 200 as it fell before, buy into it. And we're preparing ourselves to do a high probability trade. Let's continue. The next security, Meta, which is announcing earnings. Again, another broken record. Guess what happened? The same thing, capitulation, Q4 2022. We told you to get into it. Very few times Meta has pulled back, but each and every time Meta has pulled back for our short-term, intermediate, and long-term indicators, we have bought. If Meta announces poor earnings and falls back, we will buying more into it, and we feel Meta will be leading the way. We have a gain of over 102% in less than a year on Meta, and we feel nothing will change. We go back to the investment philosophy, like a broken record. Are we in a bull market? Check. Are we oversold? Not yet, but we're waiting to be oversold to buy in more. Is Meta cheap? No way. Is Meta on an uptrend? Obviously, Meta is on an uptrend. Do we have stop losses in play? Correct. And have we maintained consistency in what we've said? Absolutely, and more absolutely. We will wait for the short-term indicator to go lower. We will give you the signals for the short term and the intermediate term, and also for the components. We'll be also using the CCI to dip, and I think this will only go to 100 and 0 and bounce off the 0 level and come upwards. This is a win-win situation where it's very difficult to lose if you have built in a long-term position in these three securities, believing the overall market will go upwards, believing that these three securities are the few selective companies that will lead the market and give you the QQQs of positive return, including Microsoft and Google. Then on every sell, on every pullback, we are buying. This has worked very well for us last year. I don't expect it to be that easy as it was last year, but I do expect the same thing to happen. Buy on pullbacks on selective companies that are trading above moving averages, headed on an uptrend, and do this all year round. It has proved to be profitable for us, and we believe it will also be profitable for you. You know the catchphrase: study it, analyze it, adapt it. Peace.